Chanos made one of Wall Street's largest fortunes by predicting the falls of Enron and Tyco and by foreseeing the mortgage crisis. He's also the president and founder of Kynikos Associates. Jim, good to have you back with us.
Always good to be back.
So, macro picture, let's start there, because I think everybody's trying to make sense of it. I know we will talk about China later on, but we're focusing so much on Europe. Do you pay a lot of attention to what's going on in Europe?
I mean, obviously, as market participants, we've got to pay attention to it, but we're as befuddled probably as anybody else between what the reality is and what the policy prescriptions seem to be.
Does anybody know? Because we just had a guest saying, but everybody kind of has factored in what's going to happen there. Do we really know?
I don't think anyone knows for sure, but the way we view this is through the prism of the banking system. And I think that this is all about trying to protect the valuations that the largest European banks have on their sovereign debt holdings. And at some point, the voters in these countries are going to figure it out en masse, as opposed to just maybe through parties and fringe parties, and figure out that in effect, their taxpayer dollars in Western Europe are going to support the banking system, much like ours did a few years ago.
You know, when we talk, though, to an investor who says it doesn't matter, it's all priced in, I think he's talking about the possibility of default, right? How serious of a problem would it be if Greece has to reprofile their debt? I mean, how much of a problem will it be for markets, for example, here in the U.S.?
Well, depending on how much Greek debt or troubled debt each institution has and where the marks will be. I mean, I think the market knows they're pretty unrealistic now, but, you know, I watched a made-for-TV movie on cable last night about people who said, oh, it's all in the market too, when Lehman defaulted. And it turned out it wasn't in the market because there were unforeseen consequences. So that's the problem. We can look at the banks and say, okay, this bank will have a haircut, this bank will have a haircut, but what we can't figure out is what other aspects of the market might be affected that nobody knows about.
Is there an investment plan that you've been making on that, or have you been staying away?
No, we've stayed away. We don't trade sovereign CDSs. I think that you know, I feel for my countrymen in Greece. I think the Papandreou government's been doing all the right things. I think, like Obama, they were dealt the ultimate bad hand when they walked in. But the whole idea of cutting your way to profitable growth, to grow your way out of it, I think is proving to be elusive at best.
Of course, if you can't borrow money to spend it, then spending your way out of it is not easy either.
No, I mean, and what that means is the classic answer is to default and revalue your currency downward and try to promote exports and tourism, which are large parts of the Greek economy, for example, and Spanish. But everybody's still playing this kabuki dance of there's going to be no devaluation, where the market sees obviously something different.
How closely should we be watching in terms of what's happening over in Europe, in terms of the U.S. fiscal position and situation?
I mean, our situation is much different. I mean, we're the reserve currency country, which gives us tremendous flexibility, and that I think helps us, you know, almost to the extent like no other. And our issues, I think, are much more manageable, certainly, than Greece and Ireland's and some of the other countries. Having said that, I mean, the long-term picture on our country is dismal. If you look at our accounting in any kind of normal accounting, our fiscal accounting, I mean, we, like every other government, keep our books on a cash basis, not an accrual basis. And if we, for example, I tell my students up at Yale that if we look at the deficit on a cash basis last year, it was $1.3 trillion. If we looked at the deficit in the way the corporations keep their books, then the deficit was closer to $5 trillion last year. And that's really significant. These are serious numbers.
So what do you think about concerns about raising the debt ceiling again? I mean, the president, back in 2006, seemed to be very much against raising the debt ceiling. Now, at least through Tim Geithner, they're pushing for it as the only solution.
Yeah, I mean, I'm not a macro guy, so I'm going to give you that proviso. That's not what we do. But I'm hard-pressed to think when push comes to shove that we're not going to see the 14 trillion plus debt ceiling you know, moved when it needs to be moved. But like everything in Washington these days, it seems to go down to the brink.
You're most famous, though, for being a short seller, sort of the ultimate pessimist, right? And we haven't heard any optimists on this issue. I mean, looking out even beyond the debt ceiling to actually taking control and cutting our national debt. Yeah. Nobody comes on and says, I think I see a solution here.
Like the problem, I'm being the ultimate sort of realist or pessimist. I can identify the problem. The solutions are going to be left to somebody else. But the problem is healthcare spending. That's it. End of story. It's healthcare. Healthcare is the lion's share of our unfunded liability. Dwarfs Social Security, dwarfs our current budget. It's healthcare. Unless we get control of healthcare costs, which continue to grow. I just saw some numbers last week. at 6 or 7% above the real economy, we're going to be consumed by it, and that at some point something will give on that front.
I mean, we're already kind of being consumed by it, aren't we?
It's bad enough, and we had a political consumption in that we had this knockdown, drag-out fight a year plus ago, and it didn't resolve the cost side of the equation.
There's a bit of a battle also going on about the muni market. You know, Meredith Whitney came out and she was on 60 Minutes. You've come out and defended her.
Yeah.
I mean, how bad do you think the muni situation is, Jim?
Look, I mean, we were talking about munis a long time ago, and what Meredith said, maybe she shouldn't have put an amount and a time, as they say. The old saying is, you can predict one or the other, but not both. But having said that, I think she underscored at a time in which there were a lot of complacency, particularly a lot of retail investors who don't do their own fundamental work and hold a myriad of different obligations and really don't know what they own. And at the time she spoke, I believe, which was October, November of last year, spreads were very, very tight, and people weren't being compensated for the risk that they took. And so in that respect, I think she did the market a favor as much as she was completely crucified by others, typically those in the muni bond market, for saying that. But I read her report, and I thought it was brilliant.
Welcome back to Street Smart. Jim Chanos has been a bear on China, especially on real estate, and that's drawn a lot of criticism online, including emails that we receive here on Street Smart. I'm sure emails he gets as well at his office. So let's put it to him now. Jim, what do you say to investors who say that you have it all wrong on China? A lot of them say you don't go there. You don't know the ABCs of China, one very wealthy man recently said.
Yeah, I know. Lately I've been taking a beating from some Chinese real estate developers, including one very recently.
One former board member of Enron.
He was a former board member of Enron, and he was on the audit committee too. But I never met him, so I can't hold that against him. But in any case, look, these kinds of criticisms, these ad hominem criticisms, are fine. But what people again don't seem to be attacking are facts. And also the fact that the property developer stocks that were short have been declining. This has been a good place to be short for the last 18 months. So, I guess we can rest on that. But actually, my team just got back from China, my research team. And
you do send people, because a lot of people say Jim doesn't come to China himself. He hasn't actually come and seen it. You don't have Shanghai shock or whatever they call it, right? But you do send your team there.
I don't ever talk to companies or CEOs anyway. I haven't for 25 years.
Right.
So I mean that at the end of the day, that can probably sway you more the other way, as opposed to just doing basic research. And I think that what my team found, they actually came back saying we're not bearish enough. Interestingly enough.
Not bearish enough.
No, that in fact the signs of overcapacity were even much greater than their last visit, which was late last year. And increasingly, the executives that they met with were sounding a little bit more uncomfortable about the current situation.
I know you were talking with our Adam Johnson before you came on set. I mean, Adam was over in China, and he talked with the vice chair of one development company. He said basically they pre-sell before building so that they've made money before they're even building.
Yeah, they pre-sell, but if you look at the balance sheet of the developers who claim they're pre-selling, and by the way, you can't now pre-sell and use the proceeds for your next development. That's changed. But if you look at the balance sheets of the developers, you'd be hard-pressed to see how healthy they were, because they're all loaded up with land, just as our developers were at the top of our market. So for every, yuan that they're earning pre-sale, they're plowing it right back and then some in new land development. So they're drinking the Kool-Aid too, so to speak.
Did you get, so if your team came back and said you're not bearish enough, so what did you do? Did you change some of your positions? Did you get even more aggressive in terms of your shorts?
We've maintained our pretty much dramatic overweight in our Chinese shorts. And that we'll leave it at that. But I think that what we're seeing now is more cracks on the facade, and what they observed almost quite literally. They said buildings they saw that were only 2 and 3 years old were already beginning to show signs of wear and tear. And there was a great Bloomberg TV report on that recently, showing new construction where cracks in the building. And I think that's not getting enough attention. Just the quality of all this fixed asset construction is becoming somewhat suspect.
Well, if you're right, obviously, about this, it's bad for the economy and it's bad for the currency as well. And I think one of the most interesting things that you told us last time you were on is you don't think that the UN would appreciate if it were set free, let's say, from its peg against the dollar. You actually think it would drop. Do you think that's one of the reasons the Chinese don't want to
think that
unleash it?
I think that's actually one of the reasons contributing to the bubble. In that it's a double-edged bet, but could turn into a double-edged sword. That investors are counting not only on asset appreciation of fixed assets in China, but they're counting on the yuan being revalued upward. And if it ever became apparent that that might go the other way, you could see a real scramble to get out of these assets in China.
I got to ask you something, because I think there was a 13F filing that showed you were actually long owning shares of China real estate information. Is that true?
There's an ETF, I believe.
Yeah. So
we have a hedge fund. We have a small long-short fund, the Opportunity Fund, which is a fraction of the size of our total holdings. And in that fund, we hedge off everything. So we were short a bunch of developers. Individual developers, we hedged it off on the long side with an ETF.
All right, so there's no real significant long play that you guys are doing.
Just hedging in your hedge fund.
We're hedging in our hedge fund, exactly.
You're not giving up on shorting on China. Kynikos Associates president and founder Jim Chanos is one of the most recognizable short sellers on Wall Street, but he does take long positions as well, and he may be moving more in that direction, or we'll ask him and see if that's true. Are you?
Well, again, in our hedge fund, which is a small part of our assets, a couple $100 million, less than 5% of our assets, we have longs and shorts. For example, to use the China example, not only are we hedging with the ETFs on the long side, but we own the debt of some of the developers against short positions in their stocks. And an interesting new development in China on that front, increasingly the real estate developers can't get bank loans for their project finance in China. They're now going into the Hong Kong market to raise money in the bond market at very, very, very high rates, as high as 15, 20%.
Is it difficult to short some stocks when you want to? We're hearing today about people trading shares of this Russian internet company. It's a small float. Yeah. Nobody's lending the stock to short. The same apparently is true with LinkedIn. It's a small float, and then people won't give their shares out to short.
That's the problem in any IPO, so we stay away from that because you can't borrow them. But that also goes to show you why you need short sellers in the marketplace sometimes to produce price discipline when things get out of hand on the upside. And when you can't borrow the shares, you get an important group of investors who are willing to risk capital to say, this is silly, who can't participate. Typically what happens is as soon as these stocks become borrowable, that's when they start going down.
Let me ask you about, Corey Johnson, who anchors our Bloomberg West show, has been following some of these Chinese stocks that list on the NYSE. It's been a story that Bloomberg's been following pretty closely.
Yeah, very closely.
Long Top Financial is one of those that apparently listed with crummy financials. People ask questions, but they listed it anyway. Finally, it turns out they're false, so they stop trading. They don't let investors out. But what do you think? Can you look at this group, this pool of stocks, and say, all right, I want to short that one, and that one?
We wish we could borrow almost all of them. I mean, that's the amazing thing. When you look at all of these companies that are either reverse merger companies on NASDAQ or newly listed on the New York Stock Exchange, almost all of them have odd-looking financial statements. So it is a real warning to investors. And I know the SEC's apparently redoubled its efforts here, as well as one of the accounting boards has raised warning flags to its members about this. You are seeing a large amount of stock promoters merging with Chinese companies in old shell companies, renaming it a Chinese name, and then flogging it to the U.S. investor who wants to buy anything China. And I think it's a very, very problematic area, and investors should be very careful.
Stay away, just completely.
It's just, I mean, there's one landmine a day in this area.
But you can't get the borrow.
No, on the professional side, we can't. So we're watching it, but it's, to me, more of a sentiment sign than anything else.
What about what's going on here in the U.S.? And I thought I read somewhere, too, that you were long on Citi. Is that right?
Again, in our hedge fund, our small little hedge fund, we're short some financials and we're long some financials.
You are long some financials.
Yeah.
What else in the U.S. market do you find kind of interesting right now?
I mean, not that much. We owned a lot of fixed income securities back in the end of 08 and early 09. Now it's almost more passive hedges on the long side versus active shorts in our hedge fund. So I think that as every month has gone by, we're finding more and more to do in the U.S. market on the short side. That wasn't so much the case a year and a half ago.
Even Larry Summers points out that he thinks there might be a bubble in tech. I mean, do you think that's only specific stocks?
Yeah.
Is it only specific stocks that are making it easy to draw parallels to the end of the tech bubble?
It's not like 99 or 98. I mean, I lived through that, and that was something. I mean, there you had companies like Cisco with enormous valuations and enormous market caps. These are still companies that have, maybe 20, 30, 40 billion market caps, But back then you had companies with $300, $400 billion market caps that went down 90%. So it is different. I think, as I say, I think the bubble is really on the other side of the world.
So when you see something like LinkedIn and the pop that it had on its first day of trading, and it's still doing fairly well, I mean, you're comfortable with that in terms of what we're seeing?
I'm not comfortable. I would never own it, but again, I can't even borrow it, so we're not even remotely looking at it. It doesn't make it's a waste of our time. What
about the stocks that you do want to short? I mean, what sectors are you finding them as? Are they concentrated in one area, other than Chinese stocks on the NYSE?
Yeah, the Chinese obviously is our biggest area, and people know that. We're still in the for-profit education area, broadly speaking. We think that has not played out yet, and in an area of looking at budget austerity in the U.S., although the lobbyists are out in force trying to protect this industry, I can't believe that when staffers in the House and Senate look at how much money these companies are costing the taxpayer in terms of student loan defaults, they're not going to look at it, through a slightly different prism.
Maybe a lot of them got degrees there.
Hey, Jim, one thing that the three of us were talking in the break was about healthcare.
Yeah.
I mean, what do you think the outlook is for healthcare stocks at this point?
I mean, we covered most of our healthcare shorts, as I said, after we looked at the healthcare bill, which I think was probably a bigger lost opportunity for Washington than the financial reform.
Right.
Because you finally got everybody together focusing on this issue, and when it was all said and done, the sausage that came out of the grinder was in fact an enhanced coverage bill that was going to increase costs. And that might have been politically one of the goals, but it's going to be much harder to bring everybody back in this environment back to the table in a couple more years and take another whack at it. And I think we missed a golden opportunity. Healthcare is the issue. It's swallowing our whole deficit.
We have to leave it there. Jim, thank you as always. Yeah, we could go on and on and on.
It's always fun. Thank you for everybody.
Pleasure.
We appreciate
Thanks.
it. Jim Chanos,
My
everybody.
pleasure.